Welcome back to the Behind the Well show. Roger Abel here with Elias. Eli, how's it going today?
I'm good, Roger. How are you?
I'm very good.
Good to hear.
So I hear that your schedule for football's heating up. I know my football schedule's heating up.
Oh, is it?
Well, I mean,
your fantasy football?
Yes. You know exactly what I'm talking
Yeah.
about. So let me tell you. All right, so I did another fantasy football draft the other night.
Okay.
And so full disclosure, I do fantasy football to be involved in football, kind of like you do refereeing to be involved in football.
And full disclosure, I do not gamble on any sports, and I never have, and I never will, and I do not do fantasy football. I just had to watch the training tape from the NCAA about sport gambling. I'm not allowed to do it, but I've never done it, so it doesn't matter.
So it's ironic you brought that up. That's where I was going to go with this. Like a lot of people who do fantasy football gamble on football too.
Yeah.
Or sports, whatever. I get zero enjoyment from gambling. Like my father-in-law's like, oh, do you bet on the games? I'm like, no. Because a lot of people, I think, like to gamble so that they have a vested interest in watching the game or having like some entertainment.
That's what I hear. Most people that do it, they say,
it's
just
just
more
person.
fun. Yeah, the fans. It's more fun to watch the game. I think it's too hard to pick who's going to win and who's going to do what. And
I just get tired of losing. That's why I don't gamble. That's why I do fantasy football, because then it's like, oh, well, my player's playing on Thursday night and it's two horrible teams I had never watched, but my guy might do good. So I'm doing my fantasy football draft the other night, and I'm all excited. Like, I have this game plan. And I get the player in the first round I want. Second round, I click the wrong player. And it's someone I wouldn't have taken for like 20 more picks. So I'm hoping I fat-fingered and got lucky. And he turns out to be a home run hitter.
So how do you clicked and then submit, right? Does it give you two?
No,
or
you can click once. So I was on the guy I wanted, and my computer just like, sometimes your screen goes up or down a little bit. And when I clicked, it went up.
And there's no way to fix it?
Well, I mean, when you pick that player and the next person behind you gets the player you want, it's pretty hard to stop the draft and be like, oh, wait, I didn't mean to do that, which I did send the email to the commissioner of the league because he knew exactly who I was going to pick. He goes, send me a text. He goes, what? Wow. I go, clearly I didn't mean to do that. But so now I have more excitement because I have another player I wouldn't have had. So I'm getting ready for football, just like you're ramping up for football and all those fun things. Some big news, though, that happened recently. The Federal Reserve met in Jackson Hole and basically said we're going to start lowering interest rates.
Yeah, it's time for a shift in policy.
Well, and, I think people have been expecting this for a while. If you think late last year, stock market rallied into the end of the year, expecting rate cuts in March. So we've actually been pretty patient from March through September. And the markets have actually reacted fairly well. I think the one thing that came out of that meeting is that they believe they've got their handle on inflation, but I think they're pretty concerned about unemployment because unemployment's spiking pretty rapidly. And I don't know what the rate cut's going to be, but I've been doing some research, and I think it might be bigger than a lot of people actually expect.
You do think that?
Yeah, I've seen. I watched a couple different, and I don't speculate. Like I don't know what it'll be, but I've watched and researched a few different economists that believe it could be larger than we all think.
Really, and is that because they believe that there's more risk to employment increasing?
Yeah, if you think about the Fed mandates, two things: stabilize, inflation and employment. That's their mandate. That's what they're in charge of doing.
And I think there's a lot of talk. Hopefully they didn't wait too long to start cutting, but
they waited too long to start raising.
They probably did wait too long, and the economists I've been listening to and then like the data I've been looking at, once unemployment starts to trend up, it's a pretty aggressive number. It's pretty hard to get that to moderate.
Well,
throughout time it has been. Maybe this could be different, but I don't know.
Sentiment.
Yeah.
That's what it really is. And sentiment sways like, 2 years ago, man, if a house hits the market, I better buy it. Well, today, house hits the market, like, overpriced. Everybody's waiting.
I'm good. Yeah, I'm good where I'm at.
I watch the housing market, and there's, number one, I enjoy it. I like to see what's happening with prices, and I like to buy real estate. Personally, I don't do it as investment properties, but personal real estate. And I've noticed that there's a lot more listings, and they're sitting on market a lot longer, which is indicator number one that market's softening. I think the other indicator is the days of paying over ask and waiving home inspections. Those are gone.
Yeah, that's all gone.
Those are all gone. And if you look at some of the higher valued homes in our market, they're all starting to take price cuts. I mean, I'm not talking about little ones, large ones, 20% price cuts. So with that said, I think it was just a good little snippet. And I think, hopefully it provides some reprieve to the borrowers who are out there. If you are a person who owes money either on a line of credit or you have a business line of credit or maybe a credit card, as rates come down, it should help those individuals with those interest
So do you
payments.
think if unemployment starts to be a problem, do you think that that's going to bother people more than inflation has? And the reason I asked is, this is the first time that I've seen inflation like this. Certainly I'm talking since I've been an adult, right? Graduated college, been in the working world. And for me, it was really eye-opening to see how much people don't like inflation. So now I'm starting to wonder if people have, if your friends, family, neighbors, if a lot of people start to be unemployed because economy's slowing down, I wonder if people are going to dislike that more. I'm not sure because I've never really seen this.
Well, most of us haven't seen this. If you're under 40 or 45, you were a little kid. I was a little kid the last time inflation was like this, right? That was the 70s and 80s. I was like 4. So I don't remember it either.
Yeah. But unemployment of like 2008 and 2009?
I think about this. People can manage inflation as long as they have income. For example,
I like that.
Instead of going to Whole Foods, you go shop at whatever your local, you go to Walmart for your groceries. Like you managed inflation. You went from whole paycheck bag of groceries. That's the nickname for Whole Foods is whole paycheck because one bag of groceries is a whole paycheck. You went from whole paycheck to, the discount food store. So you can manage inflation.
Here's something I thought was funny about our house, and I think it's a way to measure sentiment. I'm talking about my personal house to measure sentiment. So we reuse our grocery sacks and the little garbage cans in the in the garage or the laundry room in the bathroom.
We all do that. That's the greatest idea ever.
So the other day I was looking and I was like, I think when there's more Walmart bags, sentiment in our house is we gotta tighten up, and then when there's more Target bags, I think we're feeling a little more flush around here.
So let me tell you,
bag storage.
Outside of the ambiance of both those stores, I'd rather go to Walmart
because of the prices.
No. They have everything.
Oh, they just have everything.
If I go to Target, I went to Target the other day, getting some groceries. 4 of the things I needed, and they didn't have honeydew melon. I'm like, oh, okay, that's pretty common. You're out. Like just normal stuff that I expect a grocery store to have, they didn't have. If I went to Walmart, they've got every brand, everything, and lots of it. So every time I go to Walmart, I'm like, why aren't I going here more? Not because of price. It's purely the convenience of not having to go to multiple stores. Now, it's 3 minutes away. It's three minutes further from my house, so I don't do it. I go pay up. But so your question about unemployment. People can manage rising prices as long as they're employed. Well, team up rising prices with no money, meaning you're unemployed.
Yeah.
I definitely think unemployment, people like way less, and has way more of an impact on the economy. Like, oh, wait, what happened in the economy? Housing prices fell. Everything fell. Like it was free fall. That didn't really happen with, inflation. Things just got more expensive, and there's a certain segment of the population that prospered a lot through this inflation.
Because of inflation.
If you owned assets, it doesn't really matter what asset you owned, which was weird with this period of inflation. You could have owned a used car in 2021 and sold it for more in 2022. So if you owned assets, you did better. Where when people are unemployed, everybody unemployed does poorly. So I understand, and I think that's probably why some of the people I've been following tend to think it may be a more aggressive rate cut than people are actually expecting.
Yeah, I could see that. And I guess with higher, I guess from the health of companies, inflation's not a huge thing because their bottom line's going to be, right? If the cost of goods is more, their revenue is going to be higher. But then as unemployment goes up, I mean, if your customers don't have any money to spend, it doesn't matter what the price is.
Right. I think unemployment's way worse. I mean, they're both not great, but I would think unemployment's worse than just pure, like manageable inflation. Where we're at right now, it's 3.3% year over year. Like that's manageable inflation.
Right. So that would be kind of surprising if there was a rate cut that was much higher than expected, because so far they've basically done what's been expected throughout this event or whatever the last couple of years.
Yeah, I don't know what's expected, a quarter to a half, somewhere in there. I don't even know what's priced in.
I think a quarter is, well, I've heard people say a quarter of a point is what they're expecting to do, but then I've heard people say they believe people are pricing in too high of rate cut. You know, it's just like, it's hard to know. It's hard to speculate on it. And it's hard to know what the right decision is.
If unemployment's 3, if inflation's around 3 and we have a target of 2 and we're at 5.25 on interest rates right now, 5.25, 5.5, and we need to get to 3, like what's the path to get there by the end of the year? 3 cuts of 50 basis points puts you at 3.5. Puts you at 4. You're still above where inflation's running. So I don't know. It'll be interesting to see. I don't. Truth be told, it probably doesn't matter all that much for our long-term investors. I think it's just fun to talk about, and I think people are actually following it as well. Another article I ran by, and this at first I read this article, I'm like, no way. This is on Forbes, and it was put out August 15th. But it says why your retirement likely will include an AI, so artificial intelligence, humanoid robot.
I love this idea.
At first, I'm like, no way. But then I read the article. And by the end of the article, guess what? The able household would like to have one.
The Jetsons, dude. We're going to have butlers that are robots and drive us around.
So when did the Jetsons come out? Like the 80s? 70s?
Oh, I have no idea. It was an old cartoon when I was a kid.
Okay, so
I don't know what that means.
I would have been watching the Jetsons like 85. I would have been 7. That's probably about the time. So we've been talking about this for 40 years. Do we actually think it's going to happen?
I hope so. I like the idea of, here's what I can say. If you could go buy, if there was a robot that the technology was good and they knew it was going to work and it could be your butler and drive, I want a driver too, and I could afford it. What would stop me from having that and never have to clean, never have to do laundry, never have to cook, other than when I would still grill and barbecue because that's a hobby of mine. But, you know, let's say I want to go grill steaks and then say, hey, Mr. Robot, go cook the potatoes and the vegetable sides that I want and clean up after me.
Okay, think about how efficient and how much I actually think you would save money. Here's why. You tell the robot what the meals are going to be. They should be able to go order exactly what they want from the store in the exact quantity, not overcook and not have a bunch of food going to waste. Like when we go to the grocery store, when I go, I have a list and I get the list plus 20 other items. The robot would not have the latitude to say, oh, that looks good. Let's grab that too.
That's interesting. If they knew your personality, though, would they do like an upsell purchase because they know they're
Mr. Abel loves brownies. Let's grab brownies today. I don't think so, but that would be interesting. So I don't know. At first I'm like, that'll never happen. But when I heard it could do, think about all the help it gives you at home with your family life. No one has to figure out who's going to load the dishwasher. Nobody has to figure out who's going to fold the clothes.
You don't even need a dishwasher anymore.
They'll just wash it for you.
They'll just wash it.
The other thing, right now, where did I read this? So when I hear like humanoid robot, I think of lots of money, right? Like, I'm thinking these things have to be like $100,000. Goldman Sachs research, they said the cost of producing a humanoid robot's between $30,000 and $150,000 per unit.
To produce it.
Right.
So they're going to cost
anywhere
like double that range.
But let me ask you a question. On the low end, because I'm guessing the higher end 150,000 bots to produce do more stuff. If the $30,000 robot that's going to retail for $60,000, let's call it, could fold your laundry, cook your food, clean your house, would you buy it?
Yes.
And I would too, because I view that almost like a vehicle. Like, yep, I'll buy that because it's doing more functions than it could drive my vehicle.
Well, you're buying time too.
You're
buying time. And then if you were worried about paying for it, okay.
They're going to finance
How
for
long
people.
would it take you? Like, if you're worried about paying for it, but that robot's doing everything, how long would it take you to pay it off by going to get a second job? And would you rather work a little bit more, or would you rather do all the chores around your house?
I think the robot will pay for itself in efficiency.
I agree with that.
I mean, just think of, okay, I don't need Uber anymore. The robot will just drive and sit in the car and bring me back. I don't need the house cleaner. I'm going to spend less money at the grocery store because arguably the memory capacity is unlimited. I mean, the memory in the system. So instead of having 4 jars of peanut butter, because we don't know if we need peanut butter, the robot always knows what we need, which just leads to less waste, less consumption, healthier lifestyle probably.
Yeah, it's everything. You wouldn't have, like you said, the waste. You wouldn't just have extra stuff in the house.
How many things have you went and bought? Like, okay, I have 5 jars of pickles. Because you do a barbecue and you think you need pickles. And do you take the last 3 pickles or you just open the new jar for the barbecue?
I can tell you right now, we have 8 different boxes of noodles, different types of noodles in our cupboard right now.
And you won't eat half of them. They're going to expire. You're going to have to get rid of them.
Right. Where if we had a robot, I could say, hey, robot, over the next month, I want to use up all these noodles, come up with different dishes.
Make recipes with the ingredients I have.
That would be awesome.
Go figure out how to make a recipe with what's in the house. So I thought that was a cool article. George Jetson, get out there a little bit. It's great.
And for retired, the other thing I was talking about with retired folks, I think it could also help. I mean, what if it could start helping take care of seniors? Like you have a robot design. I mean, that could be one of the functions, and I would understand why people wouldn't want all of their health care from a robot, but like the daily living stuff, like feeding, bathing, going to the bathroom, I think people would rather have a robot help them than a family member, right? Do you really want a family member helping you do some of that stuff, or just have a robot that can do it?
I definitely think that is a huge benefit if this can actually come to fruition. And then it begs the question, once it comes to fruition, do people need to start figuring out how to build this into their retirement plan? Like, are we going to budget instead of...
Can I afford a robot when I retire? People will probably start asking that question eventually.
No, but think about it. So right now, if you poll a lot of the individuals we work with, their number one concern, you'd think it's money or outliving money. Their number one concern is how they're going to take care of themselves. Healthcare, long-term care, assisted living. Well, what if the robot allows people to stay in their home longer? The cost is, I mean, $160,000 for a robot compared to going to assisted living, significantly different, right?
Correct.
Right, and
you could spend $160 in 2 years.
Well, and the robot's an asset. It can be sold. It's not like when it's done, it's worth zero. It's like any other car, vehicle, house. You can sell it. There'll be a used robot market, I'm sure. But I think that is actually the real question. When do we start seeing people ask about it and start to build it in? And I'm going to guess when it's actually offered to people. But I would tell you, there's a robot out there that can help me in my house, I'm doing it. Make everybody happier.
It'd be hard not to.
Yeah.
It'd be hard to not do it.
So, Elias, as we get into the meat of the show, one of the things I wanted to talk about, and I think is often missed, especially by the DIYer, and those are 401k rollover mistakes. And some of these mistakes cost savers billions of dollars over their course. And if you think about when somebody retires or they leave a job, what do a lot of people do? They roll it over. And
yeah, they do a rollover.
And if you do this with a professional, most of these things should not happen. But one of the things, I was reading an article in Wall Street Journal, one of the huge mistakes people make when they do a rollover is they leave the money invested in cash. Right? So
once the rollover's complete.
It's like 68% of the people. Once the rollover's complete, the money stays in cash for too long. So Here's what happens. They think when they did the rollover, they bought an investment. And this is primarily done by do-it-yourselfers who think they can figure this out. You actually have to go select the investments. Right?
I haven't made any money. Yeah,
you're in
the sweep
This
account.
is exactly what the article talks about. Okay, you ready for the statistic?
Okay.
People 20 to 29 years old, arguably the people that should be the most aggressive because they have time on their side, the best opportunity to let compound interest work for themselves. Average cash balance for a person 20 to 29 years old after 7 years of the rollover. Give me a guess of how many people still have the cash balance from the initial rollover 7 years later.
Well, I'm going to guess high because you said a couple numbers already.
I don't think you're going to guess
55%.
Yeah, that's exactly what it is. 55% of the people.
I got it right on.
Yeah, it's just over 50%.
Lucky guess.
But think about this. 55% of the people between 20 and 29 years old who try to do this themselves make no interest for 7 years. They should have doubled their money. Rule of 72 says if you average 10, you double your money every 7.2 years. They lost out on the first double, which is all the magic of compound interest. Here's what's ironic, though. The older people get, the better they do. People 60 and older, only about 20% of them leave their money in cash.
Most of them are probably working with someone.
Yep.
People at that age, they really, really want help because they're going to retire and they don't want to make a mistake.
So it goes to show, how long have I said this, Elias? They got an outcome. It wasn't a good one.
That is true.
That's what they got.
That is an outcome.
And
it wouldn't be hard. Okay, what do you have to do to outperform the cash sweep account?
The average return on cash since 1926, 0.51%. Half a percent since 1926. The average equity return, just large cap stocks since 1926, 7.19. That's 100 years.
Yeah, you're vastly better off. Well, you could go buy, you could buy CDs and do better than the cash sweep. Right now, maybe not all the time, but
here's the problem. They believe they're buying an investment. No, they're not. Those companies are custodians. You then need to go select your appropriate investment mix. It's why we encourage people, if you're doing a rollover, it doesn't matter how old you are, call an advisor and get some help. You can go to btwellshow.com. We'll help you, or find somebody that is going to help you navigate this so you don't miss out on the number one just benefit of investing when you're 20 to 29 years old. Compound interest.
Yeah, and those numbers are way too high. 55% of people just leaving in cash. That's crazy.
That's after 7 years.
Yeah, that's a long time.
And here's what's ironic about the chart. After 1 year, it's 75%. So 75% of the people didn't do anything for a year. Well, what if it was a year like 2023 and the market pops off 20%? It's a huge, huge amount that you missed out on.
Yeah, good luck.
And it takes people who don't do this a while to figure out, oh, wait, why didn't you hit it on the head? Why didn't I make any money?
You weren't invested.
Right.
Yeah.
So it takes a statement or two to figure it out. And I also think ages 20 to 29, the other reason it probably sits there longer, the balances aren't high enough that they actually care. Remember,
that's a big portion of it.
There's a number of employers that, if you have a small balance, they will automatically roll your 401k to an IRA. If you have a $2,000 account balance, there are certain custodians and employers that will just roll it to an IRA to get it out of the 401k plan. It's just going to sit in cash. You may not have even known you've done it. Now, one of the cool things that this article talks about is they're actually proposing that when an IRA rollover happens, there's a default investment option. Just like, in a 401k, if you go and roll, you get a default investment option, a target date fund. That'd actually be really beneficial.
That'd be better than cash.
Be better than cash. That's the number one thing that people miss out on when they do a 401k rollover is that they let this money sit in cash too long.
Yeah. So recently, to go along with, I'm glad you brought that up. What are 401k mistakes investors make? I've been thinking about a common thing that I feel we see retail investors do, or I should say it this way, they could be more effective at and do more frequently, and that is rebalancing their portfolio. And I came across a CNBC article on here's how to use required retirement withdrawals to improve your portfolio. I thought it was a really good take and interesting for these reasons. Okay, you have to take the money. The required minimum distribution is something that when you're 73, you have to take money out of your pre-tax accounts. And this article is making the argument that this is a good time to look at your portfolio to start deciding what to sell and what to keep. And it talks about let's not lock in losses on things that are down. And I think another good way to think about it is if you have money, let's say you have an asset class that's not doing well this year, but you believe it's positioned to do well moving forward, probably not a good time to sell that. And if you have things that have done well, it might be a good time to sell those to facilitate, one, your required withdrawal, and then also rebalance the overall portfolio. And I've never personally thought through required withdrawals in that sense, that it is an opportunity to improve what you're doing. But if you think of it from the perspective of rebalancing and doing things like good investor behavior, I think that is a good take to say that it's a good opportunity to at least be mindful of what you can be doing and where to take some chips off the table and get your required withdrawal done.
Yeah, I think that's a great point because you do have the ability to select where you sell from. And I think if you use a good example in 2022, it would have been really difficult to figure out what you're going to sell in 2022, considering everything was down. And it lends itself to having a bucket strategy, but also it lends itself to talking about how to eliminate sequence of return risk. And it got me thinking. I've been thinking a lot about rules and some blanket advice in our industry. And I was thinking about the 60-40 portfolio and the 4% withdrawal rate. And I watched a video, Dave Ramsey was all the news here recently about this 8%. You should be able to take 8% off your investments. And this, just in the last day, I've been reading all of this. And, here's one of the things I think about the 60-40 portfolio, which is used to determine that 4% withdrawal rate. The reason they use the 60-40 portfolio, the 60% stock, 40% bond portfolio in that scenario is they're trying to manage sequence of return risk. And it's a really generic way to do it. I believe the best way, instead of saying, hey, a 60-40 portfolio gives you the highest probability, create a financial plan and get a distribution plan. That's actually how you manage sequence of return risk. That's why the 4% rule exists, because they're saying they're taking into account sequence of returns. Well, if I always have 1 to 3 years of cash sitting over here, sequence of returns is not relevant because I'm not selling a stock market investment that lost money. That's how you eliminate risk from your portfolio withdrawal strategy.
So it sounds pretty simple, right? We're not going to sell things that are down and realize the loss or take the loss.
So I rewatched the Dave Ramsey clip about, how the 4% withdrawal rule is ridiculous and it's too low. And if people had a bucket strategy and combine that with his theory, I believe it would likely work out. Because his theory is if you make 12% a year in your mutual fund and you leave 4% for inflation, you should be able to pull 8. Right? Well, over a 10-year period of time, during times of prosperity, if you pulled out the gains and put them into cash, that would work out. Right? So the market goes up 20%. Okay, so in that year, you take 16% out and you put it into cash to fill up your cash bucket. When the market goes down, you only take from your cash bucket. Doesn't matter. Like, you let it get back to where it is. I want to run some math on it, because I think the way to manage the risk for retirees is through our bucket strategy and running a cash bucket instead of selling investments to get their earnings. And it's a problem with a default investment strategy like a target date fund. Target date fund, what do you do when you need a distribution? Oh, I need 10,000. Great, they sell a little bit of everything. Doesn't matter what's up or down, they sell a little bit of everything.
Yeah. Well, that goes back. One, you need a distribution strategy. And we're also, you're also talking about rebalancing too.
Rebalancing, that's exactly.
Something where, and that's one of the biggest mistakes retail clients or retail investors, I think they miss that right there. Or they don't rebalance. Okay, if maybe you're running your own bucket strategy or you have cash, well, right?
Time out. Nobody's running their own bucket strategy.
I'm assuming someone out there is. How many individual
advisors or how many individual people doing this themselves do you know that have a bucket strategy?
I've never met someone.
I've
never met someone that had one.
I'm talking about very intentional. Like, hey, this is why I have 3 years. And if you don't know why you should have 3 years, reach out to us. We'll tell you why. I'm not going to give away the secret on air. But I'm sure there's at least one,
I'm sure there's a percentage of people that subscribe to that and do it for themselves.
Maybe. I'm going to say it's less than 1%. Considering only 26% of the population is actually confident about their retirement.
It's possible.
And that's exactly the number of people who've done a financial plan.
It's possible.
If they're doing it on their own, they have a background in finance or investing.
Yes, I agree with that. So anyway, so where I was going, if you do those things, I think that's where you can, and I think you would agree, I think people can withdraw more than 4% of their portfolio if they're doing it strategically and rebalancing, and they have, I know that we work with people that take out more than 4%. And I personally believe if you just have a basic 60-40 portfolio and you take out 4% a year, I think you're not going to spend as much as you should.
You're underspending. You're 100% you're underspending.
Yeah, you're cutting your lifestyle short of what it really could be.
So let me tell you the other problem with all of these scenarios. They all assume people are going to increase how much they spend each year by the inflation rate. So what that means is...
Which is not reality.
So what that means is and I want everybody to listen and put yourself and think about this from your perspective. You have $5,000 coming out of your IRA each month. When was the last time you called up your advisor and said, I need an extra 3% this year because inflation went up 3%, so now I need $5,150 each month?
It doesn't.
It never happens.
No.
Typically,
people will go several years and then...
Most people never increase it. And you know why? The first 10 years is their biggest spend. And then they hit the slow-go phase, and they don't need more money. They spend less money.
Yeah, they're cutting back a little bit.
Well, it's
not by choice. They're just slowing down.
It's unintentional.
Yeah.
It's just they're like, I don't need to do that. And they're used to living on that paycheck they've had for the last 10 years. So we all talk about, you have to have, this withdrawal strategy, like this 4% withdrawal. So inflation creeps in. Well, very few people that I work with has their monthly distribution went up over 10 years. They're taking the same amount of money.
I would say the vast majority, it stays the same.
It stays the same.
I will get a call occasionally to increase, but it's never, the conversation's never, well, inflation was up 9, I'm going to increase 9. They haven't given themselves a raise from their distribution for years, and then they'll say, hey, is it okay if I do like another $500 or $1,000 a month? Like they just ask for a set dollar.
In 21 years, it's never happened to me. Not one time.
You've never had someone ask
that? Not, hey, I need to increase it 3%. Yeah, I've had people increase their distribution.
Okay,
but
I get you.
Elias, it's very rare. Very rare that I've had someone call up and say, hey, I need another $1,000 a month. I mean, I'll bet on
probably
less than
the exception. It's not really the norm.
And we work with thousands of people here. Yeah. So I'm really trying to educate people on why the blanket advice just isn't always the best outcome for you, and why you should do an individual financial plan, put together a distribution strategy as you get there to eliminate the pitfalls and all the things that could happen in retirement. Most of the stuff you can plan away for. You can plan away for a lot of stuff, but if you're just kind of winging it, it's going to be pretty tough. And
or you'll make a mistake and it's hard to recover from a mistake, certainly after you've retired.
Well, and the people who actually go through the process and put these pieces together, their level of confidence is significantly higher.
Yeah, their confidence is higher, and how much their level of worrying and stress is a lot lower. I think that's probably one of the biggest benefits for our clients is they just don't worry about all this stuff. We're doing it for them. I actually had someone the other day, I had a suggestion for something I thought that they should do. Just we were going to do a rebalance, a couple small changes. And they said something like, I just always assume that if something needs to be done different, you're going to let us know. Because this particular client never looks at their account. The only time they've ever see it is when they get a report from us at their review. Doesn't log in, doesn't take statements in the mail, and said, I just think if we need to do something different, you're going to tell me.
And they're probably doing better than most because they get out of their own way.
Right. And he did make the comment, if I look at it, I'm going to worry about it. Where if I don't look, I don't worry, and I just enjoy my life more. You guys are taking care of it. It's like, okay, well, good.
We have
That's
a couple
the value
clients
then.
like that. Yeah. Well, with that said, I want to thank everybody for listening to the show. I thought we provided some valuable information. Elias, please do me a favor. Keep your eye out when the robots go on sale. I'm going to buy one. I can test it out and let you know how great it is. If you're not following us on Facebook, social, YouTube, X, go ahead and please subscribe for the information if you like what you're getting, and we'll catch you next week.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal,